Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
So we're already, in our planning meetings, we're already starting to get a lot of conversation centered around the next election, which is not until 2024, but people are already getting amped up about it. And also we have a mix of client base here that we have pro-Trumpers already. We have pro-Biden, and I don't know if it's actually pro-Biden, but okay with Biden, not Trump. We have that category. And obviously there's people that have other persuasions that may not actually make the ballot list.
But we live in such a 24-hour news cycle now. They're already filling it up with something that's going to occur in late 2024.
Right.
Yeah.
So it just kind of, obviously elections are very important. Direction of the country is very important. But our job is to do financial planning and manage portfolios. And, really Congress probably has more of an effect on planning than the individual president would. But which is interesting because congressional approval rating is always like the lowest, right? But they're voting on the group, not an individual,
right?
Where the presidential approval is, really based on one person, not.
It's thought that everybody says, well, my guy or my gal's okay.
Yeah,
but the rest
of them are bums, exactly. But there's been a lot going on. So I guess more recent news is the market volatility along with the debt ceiling right now, and really as investors, your risk is that the U.S. bonds get downgraded or the U.S. defaults on their debt, right?
Right, on their debt payments. Right.
Yeah. And they've been downgraded before, and you know what happened after that? Absolutely nothing. Right?
Well, initially,
initially there was some fallout and some volatility, but right. You look back on it, what did it change? It changed nothing.
Right.
Essentially you're paying people S&P is getting paid to rate bonds, right? Oftentimes by the very people they're asking to be rated, right? There's a conflict of interest in the whole process. So the worst case scenario right now is it looks like a debt ceiling deal is going to go through.
Yes.
But the worst case to our portfolios is U.S. defaults, doesn't pay its bills, and their credit rating gets downgraded. That probably...
And they lose face in the international community. And then when we go out and borrow again, they have to borrow at a higher interest rate.
That would be a bigger issue.
Exactly. But what's interesting is that there may be a winner here. Okay? In this, they seem to have come to at least an agreement in concept. Now it has to be voted on. This is where we're at, depending upon when our listeners are listening.
Right.
But there seems to be an agreement here. And if that's the case, you have to think, who's the winner in all of this? And this is where it starts to get interesting, in my opinion. Okay, it's my thought that the American public, is much like the bell curve.
Right.
Okay. The vast majority of people are somewhere in the center, maybe middle right, maybe middle left. But underneath the flares of that bell curve is where the hardcore ideologists exist. Okay. They're also the loudest.
Right.
They're the smallest, but the loudest. And right now, both of them are objecting to this agreement,
right.
Which means the middle is going to have the greatest persuasion on all of this now. And we have something that we haven't had in quite some time. So we have the two sides actually meeting and talking to one another. And maybe they've come to an agreement and they can use this as a foundation for coming together for other things. Pushing aside both of the ideologues in the parties, okay?
Right.
And bringing the center together to get things done in the country. So there may be a winner. It may be.
I think in the end, you have a debt ceiling because basically we're spending more. It's like a credit card limit.
Yes.
You spent more than what your credit card can handle. So you call them up. You say, hey, I need a bigger limit.
Right.
There's no payoff plan here.
None whatsoever. None whatsoever. And when they talk about these reductions, what they're really saying is that it's not going to grow as much as we originally projected the debt to be.
Right.
So they say that this will reduce the deficit by $1.5 trillion over 10 years. But you really have to kind of turn that and say it won't grow. It'll grow $1.5 trillion less than it would have otherwise.
Right.
Yeah.
And in the end, I don't know that if that even matters. Does it matter that we just keep borrowing and borrowing? Ultimately, we control our own currency. We were told a long time ago that if it just kept happening, bad things would happen.
But they haven't.
But they haven't. And at some point, if you forecast out to like 2025 or 2035, you run the risk of like 70% of the budget just carrying debt and all of our programs,
Yes, but it assumes a certain growth rate in the GDP.
Correct. Yeah.
And if we can exceed that, we can actually grow our way, not necessarily out of it, but through it.
Through it, yeah. Absolutely.
Yeah.
Productivity is important.
Productivity is one of the most important things.
Yeah.
If you can build more widgets with the same amount of cost as fewer widgets, you're going to have higher profits and.
So, ultimately, I think there's a big question mark on that. But, today's discussion is about the 2024 election. I think by the time we post this podcast, the debt ceiling will be handled. My prediction is it's going to be noisy, but something will get passed,
right,
and it will be through it. And then the vault market will probably get a little bump because of it, because that volatility is now behind us, and they'll find something else to worry about.
Right.
In prepping for this podcast, I just did a Google search on why is fear used so much in political campaigns. And I came across this great white paper done by a psychologist. And basically, fear motivates people 2 times more than not using fear in a message, which is why we get so inundated as advisors from our clients. We get so inundated with messages of, hey, did you read this article about U.S. is not going to be the world dominated currency in the next 10 years, and you have to watch an hour and a half YouTube video, and then in the end, it's all this fear at the end. And then what do they want you to do?
They want you to buy something.
They want you to buy something, right?
I saw that coming.
So it's the same with articles, even in the Wall Street Journal. They'll talk about how value is going to be the way forward. Growth stocks can't sustain this bull market that they're in, and it's come to find out it's written by a value fund manager.
There you go.
So in the end, they're using fear to say, "Oh my gosh, what's been working for a decade is no longer going to work, and therefore you got to buy our product." Mm-hmm. It's sad that it's that way. You'd hope that you could run a presidential campaign that's built on hope in the future and how things are going to change, but no one really does that. They say, if you don't vote for me, your taxes are going to double. But that's just how the human brain's wired. It's our I guess fight or flight mechanism.
That's what I was just thinking. It probably goes way back.
Yeah.
And that's why we survived, a long time ago.
Exactly. Exactly. So you just have to understand that's why they do it. It's not necessarily because, the candidate's necessarily negative. It's just that's the message that seems to move people to the polls to vote one way or the other. So now we we're in a situation, we talked about this in podcasts before. We're in a situation where right now Trump's leading the primaries for Republican primaries by, I believe the last time I looked, it was over 25%. Then you have an incumbent, Biden, who says that he plans on running. So essentially right now, as we look at it today, we potentially have a repeat of 2020, which was very chaotic, to say the least, right? Maybe the Republicans will see the light that, hey, all we have to do is, produce a younger person. I say young, someone in their 70s would be young in this current
compared to these guys.
Right? And you get a shoe in, pretty much, I feel like. Same with in the Democratic campaign, if they chose a different candidate that was able to complete a message, maybe that would be a shoe in for that side. Someone who's pretty clean, right? But regardless, what happens is we get our emotions get wrapped up in all this, and we start thinking, oh, if we don't elect my candidate, then the whole country's going to go to hell, and I just got to be out of the portfolios. We've had this conversation with someone earlier in the year. You did, just all the direction of this country. I'm taking everything to cash. Mm-hmm. And it's not rational thinking. You're not using data to solve any of your problems. You're simply using your emotions and nothing else. And that's not successful investing, right?
Right.
We talk about all the time on this podcast that, financial success is intentional. It's a mindset, setting goals. It's not just hoarding money. It's learning how to build wealth, right? And that's the part that said, okay, let's go ahead and throw this out there now to put the back of people's minds is as we approach election season, let's look at data. What does the data say about who's in charge of the country, which party, right? Because again, we're only looking at it from an economic standpoint. We're not looking at it from a morality standpoint.
We're not looking from a political standpoint.
Yes, correct.
An agenda.
We don't care about abortion. We don't care about any of these other things that you vote for when you go to vote. We're only focused today on economics. And so my question is, if you're a Democrat or Republican, there's differences in taxation, obviously, but how are tax revenues generated? By companies
and income paid by companies and individuals.
Yeah, yes. Right. So someone's got to be making money, right? Or else, what does it even matter at that point? Yeah. That's a very simplistic view of it. And obviously, there's how do we tax the top 1% in the country? There's always those debates. Tax rates could obviously jump to be higher. Those are all things that you vote for, but we're only talking about economics, your portfolio. Right?
Right.
And there's been high tax rate decades where the markets did just fine. And there's been low tax rates where the market hasn't done well. It goes back and forth, right? There's so many factors that go into this.
And that brings up a good point. As we have this discussion, it's just a single factor. It's just some data on a very narrow slice of investing. Okay. And we're not saying that decisions need to be made exclusively with this data. Right. We're just saying that data can be collected and arranged in such a way that you can make a point. Okay. And that's what we're going to talk about here.
So let's kind of hop into it. There's what they call the presidential election cycle theory. So we're only talking about presidents right now, not who controls Congress.
Correct.
So why don't you explain this to me, Brad?
Well, an author by the name of Yale Hirsch came up with this. He authors a book. He's gone now, but his son has taken over. But he authored a book called The Stock Market Almanac. And what he did is collected data over years and years and years and years on the stock market, and then created, based upon dissecting that data, looked for trends, and then back-tested them, and then produced the hypothesis, in much the way you go through an experiment, and then has created these different types of theories that exist in the stock market today. The one that we're going to talk about is the presidential election year cycle. Other ones were the Santa Claus rally. We've all heard about it.
Yeah, I'll talk about that.
Yeah, this was developed by Yale Hirsch as well in the Stock Market Almanac. So in the presidential year cycle, election year cycle, Yale looked at these different years in an administration, the first year, the second year, the third year, and the fourth year. Wasn't concerned necessarily about where we're at in the election cycle, but rather in the administrations itself. And what he found through looking at stock market data exclusively related to the S&P 500. So that's the limit. Okay, he was not talking about balanced portfolios. He was talking about individual stocks. He's talking about an index of 500 companies. Okay, that he could use the data to look to see if there was a trend related to in a presidential cycle. And what he found, and this was very interesting, and it's been used from time to time, okay, for conversation's sake. According to his theory, okay, after entering the Oval Office, the chief executive has a tendency to work on their most deeply held policy proposals and indulge the special interests of those who got them elected. So in the first year or two of an administration, they're working towards putting together proposals and enacting legislation that they ran their campaign on. Okay, and it tends to be the most, what should I say? Interesting is not the word. What would be the right word here? Not, but rather controversial. Okay, leaning towards one party or the other's value system. Okay, and during that time period, there is some uncertainty that's caused by this. It's uncertainty in the taxation, uncertainty in regulations, and so on. So as businesses and individuals begin to work through this cycle of new proposals and new legislation, that uncertainty causes for investors to have less confidence in the market, and the returns over time, the data long-term going back to 1933, okay, show that in the first 2 years of a presidential administration, the returns are lower. Okay. In the third year of a presidential administration, what happens is the president begins to recognize that in order to get reelected, and if he's in the second term, in order to get a member of the same party reelected, they begin to introduce new legislation and new spending programs to stimulate the economy, to enhance the value of the stock market, generate more jobs, and increase the feeling of we're better off now that we're in this type of administration cycle here. And so in the third year of an administration, historically, we see the best returns. I'm going to go through these in a second here. And then in the fourth year, the president generally has to take his eye off the ball a little bit, and he goes out and does a lot of campaigning. And as well, that now there's uncertainty back in the market because there's an election coming up. We don't know who's going to be in the White House the following year. So that uncertainty causes investors to have less confidence again, and stock market returns are not as high. So in the year after an election, on average since 1933, the year after an election, the stock market has gone up 6.7%. These are actual data. In the second year, it's up 5.8% on average. In the third year, we see a bump, on average 16.3% return in the S&P 500. And in the fourth year, we're looking back at, a less confident investor base and a return of 6.7%. So it appears that there is indeed a bump that occurs in that third year, and is generally explained in the vernacular, it's the power of the purse. President and Congress can work together to get their person elected ready for the next election cycle. And so they're releasing as many funds as they can in to stimulate the economy. Okay. Now, these are just stock market returns. So let's compare it to regardless of presidential election cycles. Since 1933, the stock market, and we've talked about this on podcast, is up 7 out of 10 years, or 70% of the time.
Right.
Okay. But let's take a look at those particular years. Let's look at that third year. In that third year, it's up 82% of the time. So it increases above the average, not just the average return, which outsized returns can move the average. Now the average of positive years in that third year is higher than the average of all years. So in a couple different ways, we can look at this and say, in the third year of the presidential's term, there may be, an opportunity for investors to take advantage of that. Now, every year is different. Every year is circumstantial. And so we'll just kind of have to see.
That's taking just the S&P and comparing it only to the election cycle.
That's correct.
Where
and we're looking at causation versus correlation, et cetera.
Has nothing on economic growth, interest rates, productivity, innovation. Doesn't count for any of that, right?
Nope. It's just data.
Yeah. So is it actually correlated? Is that third year actually correlated perfectly? Not really, because even I think in his article or in his book, he even said that there's outlying factors that will happen,
and there always will be. And really, did the administration actually cause that third year to be better than the other years? So is it causation versus correlation?
It's just a pattern that someone saw.
It's a pattern someone saw. Okay.
And in the end, it doesn't mean that pattern always continues.
No.
Right? Or
and we're certainly not going to use it to make investment decisions. Okay?
No.
But this is what some of the things that get floated out there that people hear about,
It just reminds me, like my you read that, you go, oh, that's interesting. But I go back to the saying, it's time in the market is more important than timing the market, right?
Right.
So it's your overall time that you have money invested. Because I go back to, investing for 1 year in the S&P 500 is kind of dangerous, really.
Absolutely.
5 years is a lot better. 10 years is never lost money. 20 years is worst case scenario. I think was in 5% rate of return.
And in this instance, this data occurs only in an all equity portfolio.
Yeah, right.
And who does that?
Yeah, that's true. Well, Vanguard chimed in on this as well. This is the data that I pulled down for today, and basically, they're saying in a balanced portfolio that presidential elections don't have any long-term effects on portfolio performance, and that data goes all the way back, more than half a century. And actually, they say that U.S. equity volatility in the months preceding and following a presidential election has been lower than experienced during non-election years. Mm-hmm. So they don't see any correlation. Now, this is only referring it to market volatility, not rate of return necessarily, but just how volatile the markets are. I remember when Trump was elected in 2020, the futures tanked. Futures down over 1,000 points.
Yes.
I literally remember Carr Icahn on Fox News. He was being interviewed, and they said, "Hey, Mr. Icahn, the futures are down 1,000 points." And he was like, "Oh, I didn't know that. No, I've just been enjoying the evening." And he's okay. And the interview cut out. And later I saw him interviewed again, this couple years later. And he says, Mr. Icahn, this 2020 election is that would be the
2016.
Yeah, 2016 election.
Mm-hmm.
It's 2016 election. Now we're approaching 2020, and he says, how do you plan on profiting? So I've already profited. And he told a story. He goes, well, I learned from you guys on the air that the futures were down, so I went and bought a bunch of futures. I ran home and bought a bunch of futures, and he made a lot of money that night. So, but by the time the market actually opened, it didn't. If you look back at history, on the timeline, it didn't open significantly up or down
right
the next day. So, it's really, when it comes down to all this is when you're investing, you just have to have clear goals. I don't know that a portfolio strategy built on politics is ever a good goal. You're usually working toward something long-term, rate of income in the future, or you're trying to just maintain your wealth for the next generation. You want to make sure that your portfolios are well diversified. So we use ETF portfolios here. We hold about 6,700 stocks, about 10,000 bonds. We're not worried about going to zero, but we can control volatility by how we move around amongst those asset classes. You want to keep your costs low. Average cost of our portfolios here are 0.08% per year. That's very important. I think in this day and age, all portfolios ought to be less than 10 basis points or 0.1%. If not, you're paying too much. And then you have to take a long-term view. So it's frustrating. It's frustrating probably, to open up a statement and see loss after loss after loss, which seems like it's going to last forever. But we've talked about this before in times of crisis, is that when you're going through something, it feels like you've been through it forever, but that's not the reality. The reality is it's just a season, right? Mm-hmm. An election year is just a season.
Exactly.
It happens like winter every single year.
Yeah, it does.
But it is a season, and I feel like 24 is going to be more nasty than in the past. Trump has some really good and implemented some really good economic policies, but what I'm most disturbed about is his ability to just be flat out rude and target people, and then now that has become a constant in politics. People will just say the meanest, nastiest things about each other, and that's okay now.
And it also detracts. It detracts from the conversation that needs to be had between politicians,
right,
so that the voting public can discern and make a decision, because
Correct.
they're just distracted by the comments,
right,
yeah,
right,
and the behavior.
Brad, you printed off this great diagram here.
Yeah, I love that. Yeah.
Basically, it's a diagram of Republican, and it's an elephant, it's a donkey, and basically potential outcomes. So you have House, Senate, White House. So if it's if it's split, so you have donkey and elephant, everything's split. We have a divided government, which the implications are policy gridlock, but it's market friendly. Markets do well during periods of split government.
They do.
We saw that during the Clinton years, actually. Mm-hmm. If Democrats control or if Republicans control everything, either one, you have policy consensus, but you get a lot of short-term volatility because there's probably a lot of change happening all at one time.
And it's difficult for investors to keep up with it all.
Yeah. Mm-hmm. And the bottom line is you should never build a portfolio that is built toward one particular government's policy, whoever's in charge, whatever the government policy. Right now, there's with Larry Fink and all the BlackRock people that are in the White House now, working for Biden and pushing through the BlackRock agenda. Their big thing was ESG. ESG probably was not dead on arrival. People still have millions of dollars in these things, although there's been a considerably large withdrawals from ESG funds because people realize they're paying 5 times for the same performance and holding the S&P 500 with the same stocks. It just doesn't make any sense. If your financial advisor is using ESG funds, I would run. They're just pandering to maybe what you asked for, but they didn't tell you the truth. They didn't tell you the whole thing was a scam. The SEC is starting a big investigation on that too.
They are.
So many funds are saying ESG, but they're not ESG.
Right.
Yeah.
They're represented through their name, but they're not actually performing the task of an ESG manager. ESG has been kind of quiet lately. It's kind of interesting that as we're moving into this election cycle, that ESG has kind of quieted off just a little bit.
It's no different than low volatility funds, which became more volatile than the S&P. It's no different than all the other funds that pop up. Great marketing, people buy into it, and then it all kind of fades away.
Yeah,
the classics are still here, still making money.
That's it.
ESG branding reminds me of there's this little airline I don't know if they're still in existence or not, but they'd fly a Cessna Caravan with a turboprop engine. So as a propeller, and you'd board it at Hartsfield and you would fly it to Chattanooga. And they went to like Columbus, Georgia. I mean, some other little short runs. Holds 16 people, 2 pilots, no flight attendant. And on the side of the airplane, because people see a prop and they see a single engine prop, they kind of freaked out, right? They had the perfect marketing play. On the side of the plane, they wrote EchoJet. EchoJet. Yeah. And I'm like, that's a prop.
you can call it whatever you want, but it's a prop.
It's a prop. It's a turbine. It's still a turbine, much like a jet engine. But to make people feel better, they go, "Oh, it's a jet. It's just an EchoJet with a prop on the front." You have no idea what they're talking about. That's what ESG is. ESG investing is putting a different label in the S&P 500 and charging 5 times as much. And yeah. Anyway, so the bottom line is, as we approach 24, just remember that the portfolios could be more volatile, but you're a long-term investor. You're focused well past whoever you're electing as president. Your money has to work longer than that. Right.
Right.
And I always tell people too that if capitalism's on the ballot, then we'd probably be thinking how to hedge that. Right. But capitalism really has never been on the ballot. No one's ever said, we're not going to be the country that people come to start businesses. We're not going to be a free enterprise. No one has ever said that. There's education systems in other countries are probably way better than what we have in the U.S., but yet our free market system wins every single time. And I think ultimately that's what you have to focus on, because this next cycle is going to be very polarized with a lot of nastiness, I believe.
I think it's inevitable that it'll be one of the more nasty cycles. We've kind of devolved into this, and I think that politicians recognize that they can do this and get away with it, because in the past couple cycles, they've gotten nastier and nastier, but somebody still gets elected.
Yeah,
yeah,
exactly. And a lot of good people. Unfortunately, a lot of good people sit on the sidelines.
That's a whole other conversation. I agree with you completely.
There's no incentive. There's just no incentive to become someone working for the people right now. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. A couple things to remember. We have a YouTube channel called A Wiser Retirement. In our episode notes, we've linked to a video on how to be a long-term investor, what's the right time to invest in the stock market. Those are 2 great videos. That second one there, Brad, is not what you think it would be. You would think that you'd have to time your entry, but always amazed to see that Vanguard report stating that it doesn't matter when you enter, you just got to be in it.
Yes.
So much of investments is derived by income. Other podcasts you might want to download: 5 Principles to Successful Investing. That's episode 165. And then episode 89, one of my favorites, Active versus Passive Investing. This is episode 169. Amazing.
I remember the first one.
That's right.
Yeah, you and I. Well, here we are again.
Here we are again. That's
later.
Right. All right. Thanks for listening. We'll see you guys next week.
Great.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and/or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.